Thanks for clicking! Interest rate cuts may not be coming until at least June of this year. This according to a number of economists who are pushing back their rate cut bets as a result of apparently resilient economic data coming out of the United States and Canada.
That doesn't mean anything.
And while these views were no doubt reinforced by the hotter than expected inflation data coming out of the United States this morning, voices have been emerging that point to a more longer-term, systemic shift on interest rates. A shift in the neutral rate of interest, what economists call R star. Given that, as we'll see, Western economies, the economies of both the United States and Canada, have not performed as badly as many had anticipated, some are saying that the longer-term level of interest rates may have to remain much more elevated than many have been anticipating. So what I want to do today is go over the neutral level of interest, or R star, discuss why some say it may have risen despite the past 15 years of historic lows, and then discuss some implications for the future. While U.S. inflation data came in hotter than expected today, sending Canadian bond yields rising, Canada's own CPI data is set to be released next week. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the neutral interest rate. Onto the neutral interest rate, or R star. First off, what is it? According to a TD report released late last year, the neutral rate of interest is the federal funds policy rate, adjusted for inflation, that neither stokes nor chokes off economic growth. Or, as Brookings puts it, the neutral rate of interest is the rate at which monetary policy is neither contractionary or expansionary. So, the neutral rate of interest is the interest rate, adjusted for inflation, that neither stimulates nor contracts. Now, it is important to note, as Brookings says, that the neutral rate cannot be observed directly, but rather can only be estimated. It's basically what economists, central banks, the powers that be, think it is.
Trust me.
So, if the policy rate, adjusted for inflation, is higher than this hypothetical neutral rate, then that would be restrictive. That discourages growth. On the other hand, if the policy rate, adjusted for inflation, is lower than this hypothetical neutral rate, then that would be an accommodative monetary policy, a monetary policy that encourages spending. Let's take a look at an example in Canadian terms. Right now, the Bank of Canada's policy rate is running at 5%, and Canada's inflation rate is running at 3.4%. So, that's a real interest rate, the policy rate adjusted for inflation, running at 1.6. If Canada's neutral rate was running at 1.34%, which according to the Fed it was in the third quarter of 2023, then Canada's policy rate is restrictive. So if a 1.34% interest rate would be neutral, neither stimulative nor restrictive, and Canada's current real rate is 1.6, then Canada's current policy rate is restrictive. On the other hand, take the first quarter of 2022, when the Federal Reserve estimates that Canada's neutral rate was sitting at 1.83. Canada's policy rate was running at 0.25% at the time, and inflation was sitting at 4.8%. So, with a policy rate of 0.25 and an inflation rate of 4.8, that's a real interest rate of negative 4.55, or negative 6.38 from the neutral rate of 1.83, which was massively stimulative.
Had nothing to do with anything that anyone was saying about anything.
So, in summary, in order to understand how stimulative or restrictive a policy rate is, it needs to be measured not just in terms of its relationship to inflation, the real interest rate, but also in terms of its relationship to the neutral rate, or R star. And it's this neutral rate that the central banks are constantly trying to find. Former Deputy Governor of the Bank of Canada, Paul Beaudry, spoke of the neutral rate last year when he noted that savings, the integration of China into the global economy, rising inequality, and a lack of business investment drove the neutral rate lower over the past 20 years. If people are saving, not spending, and China is producing goods cheaper, prices will naturally fall, as will the price of money. And while there are probably other factors which drove the neutral rate down, one thing is clear: the neutral rate did fall over the past 20 years, with the New York Fed finding that US and Canadian neutral rates have been on a substantial decline over the past 20 years, dropping over 2.5%. However, while we did obviously see a substantial drop in the neutral rate over the past 20 years, voices are emerging amid stickier than expected inflation and more resilient economies, saying that we could be entering into a higher neutral rate world post-COVID. with Bank of Canada Governor Tiff Macklem in November, noting that the neutral rate is probably higher now than it was pre-COVID. Megan Green of the Bank of England said something similar in November as well, and the Federal Reserve's Neil Kashkari said something similar last week, noting that a higher neutral rate leaves the Fed more time to wait for cuts. Meaning, if 5% interest rates aren't hurting the economy, if 5% rates aren't leading to massive unemployment, then why cut interest rates?
You think this job is easy?
But remember, central banks cut interest rates in order to stimulate the economy. If the economy is doing just fine, which is debatable, but we're not in the massive recession that so many had anticipated, if the economy is humming along, then there is no reason to cut rates early. And as to why the neutral rate is trending higher than we've seen over the past 20 years, there's quite a few reasons why that could be, with Bank of Canada Governor Tiff Macklem noting in November that the increase in the neutral rate could be caused by higher fiscal deficits, aging societies, and larger investments in renewable energy. And TD said as much as last year as well, noting that higher fiscal deficits, climate investment, and changing supply chains, meaning less reliance on China, could be driving the neutral rate higher as well. Regardless of the reasons though, according to the Federal Reserve's Kashkari, with the US humming along, that 5% federal funds rate might not be as restrictive as was previously assumed. Now, just because the neutral interest rate may be higher than the central banks had previously thought, doesn't necessarily mean that rates have to go higher, that nominal interest rates have to move further, though some, including Citibank as of recent, seem to think that could be the case. What it does mean is that we shouldn't expect interest rates to go back to where they were even pre-COVID, back when Canada's prime rate was sitting at 3.95. Further, it also means that although interest rates are probably restrictive right now, they may not be as restrictive as we previously thought, meaning 5% rates won't restrict an economy, won't hurt the economy as much as they would have a few years ago. And if the neutral rate is moving up, if we aren't as restrictive as we thought we were, then this has two major implications. One, the central banks can wait longer before cutting interest rates, and two, even more importantly, when the central banks do cut rates, that doesn't mean we're a straight shot back down to 2 or 3%. The central banks, if the neutral rate is in fact higher, could very well move rates down more slowly than a lot of people are anticipating. They very well could take a wait-and-see approach, moving rates down bit by bit to see how the economy fares. So, in summary, in both the United States and Canada, we're seeing inflation stick around a lot longer than a lot of people had anticipated, and our economies in both the United States and to an obvious lesser extent in Canada are faring much better than those same people had anticipated. We have not yet seen a recession in either country, although those very well could be coming down the pike. The stickiness of inflation and relative resilience of both economies could very well be due to an increasing neutral rate. That is, the policy rates that both countries have may not be as restrictive as those same rates would have been a few years ago. With that said, we will continue to track Canada's policy rate and its relative effectiveness in reducing inflation on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.